Good afternoon. It's great to be back in Jacksonville. This is where actually I met Dr. Simak. Was through an acquisition. Jim was running a small GovTech business in the south part of the city, and we acquired it. And through that acquisition, Jim and I formed a relationship that's gone on now for, I think it's been over 12 years since we made the original acquisition, and it's a privilege to be back here, and thank you for having me. So the Constellation Software story is actually a bit of a startup story in and of itself. If you it's not really sort of my story to tell, unfortunately, but I was sort of a player, an early player, not at the very beginning, but I'll try and give you some context. So sort of like if you look at this photograph of the original USS Constellation, I'm sort of one of the guys kind of in the top deck, you know, looking down on the real founders that are sitting around making all the big decisions. So I'll give you some context. This is how my kids look at me when I tell them about being at the early days of Constellation. They sort of think that, you know, a picture like this is probably fitting. But anyway, I was in the mix, I was part of the game, and I think I have a few things to share to you as an investor, as a owner of vertical market software. And the picture's also fitting in the sense that we're kind of an old school company. The principles by which that we make our investments are grounded in value investing, which is somewhat ironic considering the foundation of the company is actually a startup venture. But I'll get to that, I'll give you some more explanations. So, a little bit about myself. I came to Constellation in 2002, so that's 24 years ago, which seems like yesterday. But prior to that, I was an engineer for an oil and gas company, fracking wells in the Western Canadian Sedimentary Basin. So not really anything to do with software. It's the late 90s. We heard earlier sort of about the early days of the internet and dial-up. That was sort of my life. And this sort of dot-com boom had sort of started, and I felt a tremendous amount of FOMO. It was like overwhelming, crushing that I was going to somehow be left behind working in this archaic old industry of upstream oil and gas exploration. So I went back to school, got an MBA, and became a venture capitalist like just about everybody else in 2001. Unfortunately, the internet bubble popped literally as I was recruiting for a job. The Nortel stock was declining in the elevator literally as I was going to the interview and coming from it, from about $90 a share to like $55 a share in the course of about 4 hours. So I was sort of at the tail end of venture investing. Obviously not the best time to be there. It didn't really resonate with me, but I built a tremendous amount of empathy. So for the VCs in the audience, I definitely envy sort of what you do on one respect, and I also sort of realize how challenging it can be on the other. So anyway, I'm getting a little ahead of myself to the point where I forgot the clicker. So Constellation Software was founded in 1996. And the founder is Mark Leonard, and he actually came out of venture capital. He actually worked for what is considered to be one of the most successful Canadian venture capital firms, Ventures West. And he studied while he was at Ventures West these sort of smaller vertical market software companies and found that they were absolutely fantastic businesses. They weren't fantastic businesses from a growth perspective. They weren't disruptive. They weren't sort of the next new thing, but they were great in the sense that they were extremely durable, and they spit off a tremendous amount of cash flow. And he came up with the concept of saying, what if we could take the cash from one of these businesses and use it to buy another business, and then use that cash from the two businesses to buy two more businesses? And could we create a venture-style return or a venture-style growth profile through reinvestment of the cash flows of the businesses we own? And these businesses, as he studied, were basically synonymous with any industry. So you pick the vertical, whether it's healthcare, transit, government taxation, utilities, they all have very specific software vendors within their ecosystem that serve them. So their TAM, their total available markets, are somewhat confined, but because there's so many markets, if you look at them more broadly, there's actually tens of thousands and potentially even hundreds of thousands of vertical market software companies. A bit of a yin-yang cliche to these vertical market software businesses. They're not exactly scalable in the sense that what makes them so successful is the domain expertise within the business. It's basically their knowledge of how that vertical operates that makes them almost impossible to scale infinitely. So the only way you can really scale the business is to acquire another business in another vertical, or acquire two businesses in the same vertical and keep them separate. So it's a little bit nuanced. It's a little bit different than what you think of as a classic sort of venture business that's going to grow at 100% or 200% in its early days and still grow at 25 or 30% as it matures. And so Mark wasn't really able to convince his peers that this was a solid venture, that this was something that was going to be sustainable. They were very suspicious. So he was sort of a bit like William Wallace here, and he was brave enough to actually trade his interest in Ventures West for the interest in the first investment that they had already made. And that's when he started Constellation Software, and it was in 1996. So the original CSI business plan is, like I said, replace organic growth with acquired growth and use that free cash flow and keep repeating it. And so I don't know if anybody recognizes this, but this is what's known as a fractal or a Sierpinski carpet. And so the core shape, the square, is basically subdivided, virtually endlessly to fill the space. And that's sort of what CSI looks like today. It's basically a portfolio, a holding company of identically organized smaller businesses that are really basically taught to continue to multiply through acquisition to basically continue to expand. So there's a symmetry to each of the businesses. They all sort of have similar structure. They all have similar sort of organizational principles. They have similar sort of key performance indicators, but they're effectively sized and autonomous from the main mothership. So, went a bit too far. But the results of Mark's vision are really kind of demonstrated in this slide. So you've got here the price of the Constellation Software since inception of going public until basically Friday of last week. And as you can see, that the company has actually grown quite remarkably. My kids would call this really kind of like a flex, but this is really me sort of trying to tell you that what I'm, offering here has some grounds in success. But what would you like to take away from it? So number one is that it took a long time. So if you look at the early days of when the company was public, there really wasn't anything too remarkable in its share price growth. If you were to benchmark it against one of the unicorns or something like Shopify. So it took a while, but it's also continuously progressive. As you can see, there's not really too many periods where it went up and then immediately fell back down. It's kind of a steady state, slow, methodical, compounding return on capital. And there's a number of lessons, I think, in that we can share today and sort of talk about in general. So I've been asked to speak about scale, and I'm happy to sort of bring some data to that, and also to talk a little bit about exits. Because exits are definitely the most challenging and probably the hardest decision to make for any founder. So the exits we'll leave for another slide. We'll start here to talk a little bit about scale. And scale starts to me with headcount. And headcount is really, I think, probably the most a critical thing for scaling a software organization. There isn't really the ability to move more units without more people. There can be some of that in, I guess, in some consumer-based industries, but for the most part, what you're looking at in a vertical market software business is that if you want to actually make the business bigger, you need more folks. So one way to look at it is the number of full-time employees, and if you look at the progression at Constellation, again, across the entire portfolio, the number of FTEs has grown pretty much proportionally to the value of the company as represented in the share price. And you sort of see this nice, methodical, continuous growth of the number of people under management as we acquired more and more businesses, and those businesses grew. But it doesn't really offer us a lot of insight about scaling. It just sort of says, you want to be worth more, you obviously need more people. But what about productivity? And I think that this is the important issue that we have, is to really understand what was the production in terms of revenue per full-time employee. And you can see in the early days, is when we were a public company, you saw us basically a steady progression with a hiccup towards more revenue per full-time employee under management. But then obviously it peaked, and then it went into decline until COVID, and then it slightly rebounded. I think the rebound has more to do with some specific acquisitions that we made in the last 2 years than it does with anything that we did differently organizationally. But really what it spoke to us, I think, as we looked at it, was that our revenue per employee was actually going to erode, and that we could really only get more efficient on cost per employee. And again, there you sort of see the erosion of the revenue, but also a step change as we started to outsource a number of positions, and then a continuous sort of decline as we focused on profitability. We pushed costs out because we couldn't grow top line. We can't get more efficient. We can't get more productivity out of our people. So I think that when we step back from this is that we're wary of trying to find economies of scale. So I think if you look at your software venture, if you're saying, hey, if I could just get a little bit bigger, I would get more profitable. Or when I go and I present and I say, what I believe to be my long-term customer acquisition costs or my long-term lifetime value is based on reaching a certain scale, I would be very suspicious of that. You either have good unit economics from the beginning or you don't. Sort of this idea of growing into them. I appreciate there is a point when you're just a startup and you're basically the 10 people or less. There's going to be a natural evolution to a size that's going to give you more profitability. But thinking that when you're a team of 40 and then you want to go to 400 and you'll get profitable somewhere in between, I would be a little bit more suspicious. So what we look at CSI is really autonomy. So what is autonomy? Autonomy sort of begins with trust, and it begins with understanding what to do, which are our KPIs, or our performance indicators, and it begins with a really solid plan that aligns both the KPIs and the trust with the vision of what the company wants to do. So autonomy is everything at Constellation. We have a head office of the business of about 26 people. So that's really all of the action is happening inside the operating subsidiaries. We don't prescribe things, we don't tell people how to do things, and we hope that culture permeates all the way through our organization as you sort of bring all of those businesses and roll them up together. And that's because, we've realized the limits on span and control. So what I mean by that is, what's the largest size business that one management team can actually sort of get their arms wrapped around, can influence, continuously improve their employees, engage their customers, and ensure that their attrition levels don't start to rise. And we believe that's around 100 people. So we've actually taken businesses that we've acquired or taken businesses that have grown over time and split them into smaller businesses, because we believe that the ideal span and control is probably around 15 to 20 million in revenue and about 100 full-time equivalent employees. So those are the sort of key lessons around autonomy and span and control that I think you could take to sort of your business plan and what you're thinking about. Now, the harder concept is dealing with exit strategies. So I was thinking about how to sort of present this without getting too preachy, because there's nothing worse than when you sort of listen to somebody talk about how, this is the way the life should work. But I went back and I found this. Jim Collins used to be sort of the bomb, and he used to be the main writer that everybody loved, and then somebody basically looked at the companies that he profiled and noticed that they actually didn't succeed that well. So, but anyway, he spoke about this concept of the entrepreneurial mindset shifting from basically risk and reward to wealth entitlement. And I think you really have to be sort of honest with yourself when you look at building a company from scratch. Are you building it to flip, or are you building it to be becoming an enduring business? Building to flip is definitely what investors are looking for. They're looking to basically get in, make a return, and get out. But you as an entrepreneur, you need to be sort of thinking, what are you in it for? And I do think that it's, understanding those two strategies. Am I really building an enduring business that's going to last forever? One like Constellation, in which the owners are never going to sell? Or are you looking to basically build for wealth generation and use that wealth to go on and do something else different, or, retire or do whatever? And I think that when you have the owner's mindset, it definitely opens up the number of buyers that will be interested in your business. When you build to flip, you need to find somebody that understands exactly what you're doing. You're disrupting somebody's business. You're taking somebody's lunch. So they're going to buy your business for you to stop doing that. Whereas if you build with an owner's mindset, you're building cash flow. You're building basically a stream of cash coming into your business that you can either keep for yourself or you can sell it to somebody else. And the beauty about cash generating businesses is that there's a whole range of buyers for those businesses. So, again, how do you build sort of an owner's mindset from the outset? You think about employee ownership as being part of the key compensation program. So everyone in the early days of Constellation received bonus compensation in the form of shares, as opposed to in the form of cash. So now you're basically aligned. This business needs to succeed if I want to make my payday. It's deferred gratification. This picture is of the famous marshmallow experiment that they gave to 4-year-old kids. When are you actually going to have your cash out? The bonus shares that we were given don't vest fully until a 5-year period. By that point, one of the magical things is that the amount of built-in capital gains that you're exposed to makes you reticent to sell the shares, because you're going to have to actually pay, the IRS, or in Canada, the CRA, for the capital gain embedded in those share prices. So you tend to hold on to them and defer that capital gain, which again embeds you as an owner. And basically no stock options. This is probably the one part that everybody finds the most confusing about Constellation, but we've never had a stock option program, and I don't see one in the near future. And so what does that really mean? It means that there's really no sort of, I guess what you want to call it, agency issue between the employees thinking about, I'm just really about pumping this up quickly because I want to make an exit. The employees are actually in it as owners and as investors. So the last part, this is probably more of a cultural one, is that we're disciplined in really how we spend, and it leads to discipline on how we invest. So basically keeping us frugal and keeping us sort of manageable in terms of our operating style. No private jets, no first class travel, et cetera, et cetera. And that means that when we go to people and we say, we're only going to spend this much to purchase your company, it sort of resonates in the sense that this is how we operate through and through in our lives, and that we're not just looking to rip you off. So I just wanted to say thank you, and I'll be around for the remainder of the day and tomorrow if you guys have any questions.